Welcome to our Talk Tickers analysis of United Community Bank's latest earnings. This quarter is a bit of a puzzle. We saw a really solid earnings beat, but somehow the stock price ended up right back where it started. So we're going to dig into the numbers, the strategy, and try to figure out what the market is really thinking.
Okay, let's just get right into it. The big question this quarter is a real head-scratcher. United Community Banks comes out with strong earnings, beats expectations, and the stock just takes off in pre-market trading. But then, poof, by the end of the day, all those gains just vanished. So what happened? Let's break it down.
First up, let's look at the numbers that got everyone so excited in the first place. These are the headline figures that looked so good on paper. So UCB delivered operating earnings per share of 75 cents. Now that's a powerful 32% jump from last year, and it comfortably beat what Wall Street was expecting, which was around 70 cents a share. That's a solid beat by any measure. And the revenue growth, just as impressive. The bank pulled in almost $277 million. That's a full 27% higher than the same quarter last year. We're not talking about a small step up here. This is a significant leap in their top-line performance.
And here's a metric that's absolutely crucial for any bank, the net interest margin, or NIM. It actually expanded by 8 basis points to 3.58%. In simple terms, this just means they're making more money on the interest from their loans than they're paying out for deposits. That is a huge driver of profit. And this just perfectly illustrates the entire story of the day. You have the CEO, Lynn Harton, on the call saying it was a strong one for United. And you know what? The numbers totally back him up. And yet, the market gives it this huge thumbs up in the pre-market and then just walks away. The stock went from up 7% to actually closing down 0.5%. So what was actually driving these strong results? Let's pop the hood and take a look inside. A really key driver was their loan growth. It expanded at a solid 5.4% annualized rate. And what's great is that the growth was really well diversified. They had a strategic focus on commercial and industrial lending, equipment finance, and even a comeback in home equity lines of credit. This all points to really balanced, high-quality growth. Now, this is where it gets really interesting, the mechanics behind that margin expansion. Just look at these dynamics. They've got a big book of CDs maturing that cost them 3.6%, but they're replacing them with new ones that cost them less, around 3.2 to 3.3%. At the same time, assets that are paying down were only yielding under 5%, while the new loans they're putting on the books are yielding around 7%. You're paying less for your funding and earning more on your assets. It's like a powerful, positive repricing engine. This all comes down to a concept called deposit beta. It sounds a little technical, but think of it this way. When the Federal Reserve raises interest rates, banks have to pay more for deposits to keep you from moving your money. Deposit beta just measures how much their costs go up for every rate hike. UCB has been doing a much better job than expected at keeping these costs down, and now they think they can keep their beta in the 40% range. That is a very good sign for future profitability. Okay, so with these strong earnings, UCB has also been super active managing its capital base. They're not just letting the profits sit around, they're putting that capital to work to really strengthen the balance sheet. You can see their playbook right here. Since the beginning of 2024, they've been systematically cleaning things up. They've paid down different kinds of debt, bought back some common shares, and then, this quarter, they took the really big step of redeeming all of their expensive preferred stock. This just simplifies everything and cuts down on future dividend payments. And they can make all these moves because they have a very strong capital position. Their common equity tier 1 ratio, which is a key measure of a bank's financial strength, is at a really robust 13.4%. That gives them a significant cushion and a whole lot of flexibility for whatever comes next. And the CFO was very direct about their priorities. As you can see from this quote, the focus is, first and foremost, on growing the business from within, and then rewarding shareholders with dividends. M&A is a possibility down the line, sure, but share buybacks are the lowest priority. That tells us they are really confident in their ability to generate growth internally. So the crucial point is, after a strong quarter that the market basically just ignored, what should we expect going forward? What's our call on this? All right, here's our thesis. For the fourth quarter, we're expecting stability. Management guided for the margin to be maybe flat to slightly down, which could be a concern, but it should be balanced out by good loan growth and some seasonal deposit inflows. Now, that price action, it tells us the market is in total show-me mode. Investors are worried that this momentum can't be sustained. Maybe a slowing economy will dampen loan growth or competition for deposits will get tougher. The market needs to see more than one strong quarter to really believe in a sustained recovery. So for that reason, our rating is market perform. The bank is executing really well, but the stock might need another catalyst to break out of its current range. And as always, this is not financial advice.